All right, so moving right along, in the previous lesson, we discussed the concept of continuation patterns. Now, these are basically just ranges of consolidation during a trend that typically precede continuation of said trend. Reversal patterns, however, are also consolidation ranges, but the patterns of price fluctuation represent price action behavior prior to a trend reversal. A reversal pattern is a transitional phase that marks the turning point between a rising and a falling market. If prices have been advancing, the enthusiasm of buyers has outweighed the pessimism of sellers up to this point, and prices have risen accordingly. During the transition phase, the balance becomes more or less even until finally, for one reason or another, it is tipped into a new direction as the relative weight of selling pushes the trend down. At the termination of a falling market, the reverse process occurs. Now, just for example, imagine a fast moving train, which takes a long time to slow down and then goes into reverse. The same is normally true of crypto and financial markets. The reversal patterns we're going to discuss in this lesson are the head and shoulders, the inverse head and shoulders, the falling and rising wedges, double tops and double bottoms. We will briefly discuss triple tops and triple bottoms as they are not too common in cryptocurrency. And then to wrap it up, we will go over rounded bottoms, the crucial component of the highly useful cup and handle pattern. All right, the head and shoulders pattern is one of the most famous and most recognizable of all reversal patterns. It must be noted that there must be an existing prior trend to reverse in order for the pattern to be valid. Now, referring to this chart that you see, we can see a clear head and shoulders pattern. Prior to this pattern, there was an uptrend. Prices are rallying higher with greater momentum to create the highest peak, in which is called the head. The lower peaks on either side of the head are called the shoulders. A neckline is drawn by connecting the lowest points of the two troughs on either side of the head. As prices break out and fall below the neckline at the right shoulder, this signifies a reversal in the prior trend. A downtrend now takes place. In this chart formation, a sell position can be entered at the breakout point right below the neckline. All right, so a bullish inverse head and shoulders. Now let's take an example of an inverse head and shoulders pattern. It works the same way as a normal head and shoulders pattern would. The only difference is that it's literally upside down. Now, by looking at this chart here, we can see that there was a downtrend with the head making the lowest low. Prices subsequently failed to make a lower low, hence we have the right shoulder. Then prices penetrated the neckline to reverse to an uptrend. Now notice how prices found support at the neckline level. A buy position could be entered at the breakout point from the neckline, or what is highly recommended is a buy position could be entered for the retest of the neckline, something we will get into in the next chapter. Now, price targets. So once we've identified the head and shoulders pattern and confirmed that the trend has reversed, we can also use this pattern to find our target. The method we use here is to take the vertical distance from the head to the neckline. Next, we go to the breakout point on the neckline and project this distance from there. The price target is an approximation of the possible distance that prices will move. Let's look at this example here. The length of the red vertical line from the neckline to the head is projected from the breakout point of the neckline downwards. This will give us an approximate price target. So if you enter a sell position at the breakout point, your exit would be at this target level. The same method applies to the inverse head and shoulders. If you entered a buy position at the breakout point, you can calculate the target price where you can exit and close your position in profit. Okay, so the next reversal patterns we are going to go over are the wedges. There are rising wedges, which are bearish reversal patterns typically found at the end of an uptrend, and there are falling or descending wedges, reversal patterns that are typically found at the end of a downtrend and indicate increasing bullish momentum. So let's start with a falling wedge. Now, the falling wedge can be both a reversal and a continuation pattern, and both scenarios are equally bullish, but they contain different market conditions, which really must be taken into consideration, with the differentiating factor that separates the continuation from the reversal pattern is the direction and context of the trend that the falling wedge appears. Traders should use trend lines to connect the lower highs and lower lows to make this pattern easier to spot. A break and candle body close above the resistance trend line would signal the entry into the market. A stop loss can be placed below the recent swing low, while the target can be placed according to the measured move technique. So the measured move technique of the falling wedge is by taking the last touch of the lower trend line and then taking that distance all the way up to the first touch of the upper trend line and placing that distance at the point of breakout, giving you a measured move target of a breakout of the falling wedge. Now, in order to validate this pattern and the idea, you are looking for confirmations. The first one you're looking for is a volume confirmed breakout. So a breakout means that you get a close above this downward sloping resistance trend line, and to confirm that breakout, because sometimes you can get faked out, you are looking for a volume confirmation. A volume confirmation is basically just a nice volume spike, but one way you can help standardize that in your trading is if you bring up the volume moving average. You have to actually go in and turn that on, and anytime the volume breaks this moving average at the point of breakout, that lets you know you do have a volume confirmed breakout. Now, additionally, you want to add more confirmations to the breakout of any pattern, especially the falling wedge, and some good confirmations to add would be divergences. You can observe these as the market is making lower lows, but say the stochastic or the regular RSI or the MACD is making higher lows. As we can see here, we have lower lows, and then we have a bit of bullish divergence here on the MACD histogram, letting us know that we are indeed probably looking at a reversal and breakout of this falling wedge pattern. The rising wedge is the opposite of the falling wedge and is typically observed in downtrending markets, but can be seen in uptrending markets as well as a reversal pattern. Traders ought to know the differences between rising and falling wedges in order to identify them correctly. So if you spot a rising wedge in a downtrending market, it would be a continuation pattern, and they often are referred to as bear flags and signify further continuation to the downside. Now, if you spot a rising wedge in an uptrend, it can let you know that you are approaching the apex of the uptrend, and you could be looking at a pretty significant trend reversal. Here we have an example of a rising wedge with Bitcoin in an uptrend, letting us know that we could be looking at a trend reversal here in the near future. We have two upward sloping and converging trend lines with at least two touches on each trend line as we head to the upside. We have higher highs and higher lows. So some confirmations that we are looking for in a rising wedge are once we get the breakout or the break and close below the lower support trend line. Again, we are looking for that volume confirmation. So instead of a large green spike here, we will be looking for a large red spike, letting us know that the price action is breaking below this support trend line, and we are likely headed down towards our measured move. So how do we take a measured move of a rising wedge? Well, you do it almost exactly the same as you do for a falling wedge. You go from the first touch of the bottom trend line to the last touch of the upper trend line, and you place that measurement at the point of breakout, and that should give you a measured move. So some other confirmations you're looking for: one would be the break across this level of support, two would be your volume confirmation, and of course, three, you are looking for any sort of bearish divergences in the price. And sure enough, we do have some bearish divergence here on the MACD histogram. We have a high and a lower high here on the histogram, and we have a high and a higher high here on price action, letting us know that we are looking for a shift in price action, likely to the downside. So let's go ahead and play this out and see how it works. And price action is moving along, and it finally broke the lower trend line here. Did we get the volume confirmation? Yes. So we did have two red volume spikes up across the moving average of the volume data, letting us know that we did get a break to the downside. Now, this would be a great area to enter into a breakout trade. So the breakout has been confirmed. Not only did we get the volume spike, but we had price action break to the downside. And this would be a good idea to sell or short. And our take profit or our buy area would be at the end of this measured move. Now, this measured move is only a minimum forecast. Price action could indeed head further to the downside. Okay, so one thing to note here, I definitely want to show you guys. So one thing you will get after a bearish reversal breakout. So when you get a bearish breakout of a rising wedge, and you will get the same thing with head and shoulders as well, you will typically get what's called a bearish confirmation. So when price action breaks out of a bearish reversal pattern, you may get a brief bounce that will come up and test the lower trend line of former support. This is a bearish confirmation, giving us the confirmation that this former support is now indeed resistance, letting us know that price action is in fact playing out as this pattern predicted to the downside, likely to our measured move. Let's go ahead and see if it does come all the way down to the measured move. So we're getting some brief pullbacks here. We are getting price to recover, and boom. So here's a pattern that we went over in the previous lesson. This indeed is a bear flag. So this adds further bearish confluence to the idea that price action is likely continuing to the downside. This is a perfect bearish continuation pattern movement here. So the way you take your measured move of this bear flag, as we spoke about in the last lesson, is, from the last point of the touch of the upper trend line, and we just move that like that right there. And in fact, we did come down and we did meet our measured move of the breakout of this rising wedge pattern. Again, one thing that we haven't really discussed, but we should, smaller patterns can turn into much larger patterns. So as we've already discussed, we might see a pattern here that is indeed a bearish reversal pattern. I will give you just a moment to see if you can identify that pattern, and then we will discuss that pattern and see if it indeed does play out as predicted. Okay, so if you guessed a head and shoulders bearish reversal pattern, you are correct. Now, these patterns do come in variations. They're not all perfect left, right, shoulders, and then head. Sometimes these can be complex. If you refer to Bukowski's chart patterns, that is in the members TA library section, it does get into a little bit more detail about complex head and shoulders. So here is a head and shoulders pattern. This is a bearish reversal pattern, and we are looking at this pattern at the top of an uptrend here. So we did get the break of this neckline here. Price action broke down below, and look, we do have the volume confirmation here. Price action briefly consolidates here and then heads further to the downside. Now, you might remember this price action from early last year when we did experience the coronavirus panic sell, and this was our indicator letting us know that we were looking at a pretty significant correction. This head and shoulders at the top of this uptrend was the dead giveaway right there. Okay, let's move on. Okay, so next up we have double tops and double bottoms. The double top pattern is another type of reversal pattern which has two peaks at about the same level. These are the highest peaks reached after an uptrend where prices tend to find strong resistance. Now, double top patterns signal a reversal from an uptrend to a downtrend. Now, when prices are rallying higher in an uptrend, they reach the first top or the first peak, and then prices start to retrace slightly all the way down to a support before they bounce back up to the level of resistance where we saw the first peak. Okay, then prices are unable to rise higher than the first peak and find strong resistance at this price level reached by the first peak. Now, subsequently, prices then fall back down, and after testing the resistance level in the second peak, prices then fall back down and penetrate what we call the neckline. This is when we have the double top pattern confirmed and the reversal in trend is expected to come next. Now, just below the breakout point or the neckline, you have the opportunity to enter into into a sell or a short position. So how do we calculate a measured move or a price target in a double top pattern? Well, just like in the case of the head and shoulders pattern, it is possible to calculate a price target in these double tops after prices break out and we have a trend reversal. Now, to do this, all you do is you take a measured move from the highest peak all the way down to the neckline and then take that distance and then place that at the point of breakout. That should, in fact, give you your price target for a double top. Let's go ahead and see if this double top price target actually plays out. Well, we exceeded it by quite a bit, but it did give us a minimum price target. And as you can see, there was likely a much larger reversal pattern in play. But a double top is a trend reversal pattern, letting us know that we are likely headed further to the downside. Okay, so the next reversal pattern we are going to talk about is very, very important, as we see them pretty often when we are doing technical analysis on Bitcoin and other cryptocurrencies. Now, this pattern is called the double bottom, and we briefly spoke about it in the intro lesson to this chapter, but we're going to dive a bit more in detail in this lesson. Now, the double bottom is a reversal pattern that signals a change in price direction. It is basically the exact opposite of a double top reversal pattern. This pattern signals the reversal of a downtrend into an uptrend, but as I mentioned, can sometimes be a continuation pattern in an uptrend. Now, the image that you see on your screen right now demonstrates clearly that a double bottom pattern is easily recognizable since it tends to look like the letter W. Now, as with most patterns, these chart patterns do not always look neat and clean. Sometimes they are a bit scattered, but the overall basic idea of these patterns is always the same. Now, a double bottom pattern usually forms in a situation when sellers are battling against buyers, but sellers eventually fail to take over control. More buyers enter the market and they end up pushing the prices higher. During a downtrend, prices are reaching new lows until they find support, which prevents prices from falling further. This creates the first bottom, which is the lowest level. Prices soon bounce off support and retrace up to a resistance level. When prices fail to break this resistance, there will be another sell-off to the previous low. The retest of this support forms the double bottom on this chart pattern, and subsequently prices climb higher after failing to break support. The double bottom formation is completed when price breaks above the neckline or the resistance level. Let's go ahead and look at this example of a double bottom pattern here in Bitcoin that we saw all the way back in September of 2020. So as you can see here, we do get the bottom one, bottom two, and if you look closely, we actually see smaller double bottoms inside of this larger double bottom. So if we take a look at this one here, so here is bottom one, bottom two, and then we get to move to the upside. Here too is another double bottom. We have a smaller bottom here, and then another bottom here, and a break to the upside. Okay, so we are looking for a break across the neckline. The neckline would be about here. And then once price action breaks across the neckline, we are looking for a volume confirmation, and we do indeed have a volume confirmation here. This would be a great place to enter into a long trade upon the breakout of this neckline. And let's go ahead and take a measured move. So a measured move of a double bottom is the same way we take the measured move for the double top and the head and shoulders and inverse head and shoulders. We're going to go from the low of the lowest bottom here all the way up to the neckline, and then we are going to take that distance and place that at the point of breakout from the neckline, giving us a measured move. Now, measured moves are not always exact. They are typically, though, the minimum price action that you should see out of a successful breakout of the pattern. Let's go ahead and see how price action broke out of this potential double bottom. Okay, so we did break out. We got the retest, bullish confirmation of the neckline. So once you break a resistance, once it's confirmed support, that is known as a bullish confirmation. Price action did move to the upside, and right about here, before this consolidation period right here, we did meet the measured move of this double bottom basically perfectly. So this is a perfect example of a double bottom, and there are many, many variations of these double bottoms. If you want, again, you can go ahead and look in the second edition of Thomas Bukalski's Encyclopedia of Chart Patterns, there are a ton of double bottoms in there for you to go in and look around and familiarize yourself with, because again, this is a very important pattern and it is something that we will see pretty often when trading Bitcoin and other cryptocurrencies. All right, moving on, triple tops and triple bottoms. So the triple top chart pattern is very similar to the double top. It is also a bearish reversal pattern, with the difference being that there are 3 tops, as the name suggests. All 3 tops should be approximately at an equal level. Now, it does not have to be exact, but it should be very close. These 3 highs create a resistance level, hence prices rally to this level and test it trace times. Prices are unable to break resistance and eventually reverse direction, and the trend becomes a downtrend. Now, during the formation of this triple top pattern, a support level was also formed, which prices bounced off when attempting to rally, but met resistance and fell back down to the support level. The triple top reversal is completed only until this support level is broken to the downside. This confirms reversal of the prior uptrend, and upon breaking the support line, this is a good opportunity to enter into a short position. So measuring the price target. So you measure the vertical distance from the highest peak to the lower bottom between the 3 tops. Use this same distance and project it downward from the breakout point at the support line. Triple bottoms. So the triple bottom chart formation is the exact opposite of the triple top pattern. It's a very bullish reversal pattern, meaning it shows the reversal of a prior downtrend into an uptrend. Now, during the formation of this triple bottom pattern, prices are in a downtrend, reach a strong support level, which they attempt to break 3 times. This results in the formation of 3 troughs or bottoms, hence giving the name triple bottom. These 3 troughs are at around the same level from the support line. Each time prices to attempt to break the support line, they bounce back up to the resistance line. Once prices break out from this resistance line to the upside, the pattern is complete and the trend is confirmed to have reversed. So measuring the price target of the triple bottom, you're going to measure the price target similarly to the way you measured the price target for the triple top. Now, you're going to take the vertical distance between the lowest bottom and the highest peak and project that distance upwards from the breakout point at the resistance line. All right, moving on. So rounded bottoms, these are very, very, very important continuation and reversal patterns. You'll typically find these at the bottom of extended downtrends where, price starts to consolidate a bit more heavily, and you get more of a range prior to price breaking to the upside. These usually precede parabolic moves to the upside, and you will see them quite a bit in altcoins, especially versus the USDT pair. Now, the rounded bottom or the saucer pattern is, again, a reversal pattern. And unlike the other patterns, it tends to form over an extended amount of time, and it starts to change direction gradually, and then all of a sudden, it changes direction suddenly. Now, these rounded bottoms are usually spotted on weekly or monthly charts, and they can sometimes span several weeks to months to even years. All right, the last reversal pattern we are going to cover in this lesson is the cup and handle. The cup and handle price pattern on a chart is a technical indicator that resembles, well, you guessed it, a cup with a handle, where the cup is in the shape of a U. It's not always perfect, as you can see here with this Bitcoin 4-hour chart, and the handle has a slight downward drift, typically a falling wedge or some sort of bull flag or continuation pattern of the sort. Now, this pattern is very, very, very prominent amongst altcoins and is a very good leading indicator to a trend reversal and typically a strong bullish trend. Now, the cup and handle is considered a bullish signal, with the right hand side of the pattern typically experiencing low trading volume. The pattern's formation may be as short as 7 weeks, or sometimes it can take up to 65 weeks. These are also visible on lower time frames, and you can get the same sort of price action behavior on lower time frames that you will see play out on higher time frames. All right, that wraps up this lesson. I know this one was a long one. I will put timestamps in the description below so you can go back and review each one of these reversal patterns